Please subscribe to our channel and press the bell icon to stay updated with the latest Bitcoin news, cryptocurrency trends, Forex market insights, commodity forecasts, and expert technical analysis. Join our growing community of traders and investors, and never miss an important market opportunity. Imagine buying shares in one of the most anticipated companies in modern history. The stock immediately jumps nearly 30%. You open your trading app, ready to lock in a quick profit. And then you realize something shocking. If you sell too soon, you could lose access to future blockbuster IPOs. Welcome to the controversy surrounding the SpaceX IPO. And today we're going to answer a simple question. Is the IPO system designed to protect investors? Or protect Wall Street? Let's dive in. SpaceX recently made its historic debut on the stock market, instantly becoming one of the most valuable and closely watched companies on Earth. The company, founded by Elon Musk, has transformed the space industry through reusable rockets, Starlink satellites, and ambitious plans for Mars exploration. Investor demand was massive. On its first trading day, SpaceX surged nearly 30% before closing approximately 19% higher at $160.95 per share. For many investors, this looked like a dream opportunity. Buy at the IPO price. Sell after the opening surge. Collect a quick profit. Simple. Except it wasn't. Because thousands of retail investors quickly discovered they don't play by the same rules as institutional investors. To understand why, we first need to understand what Wall Street calls the IPO pop. When a company goes public, a limited number of investors receive shares at the IPO price before regular trading begins. Historically, many IPOs rise significantly on their first day as public demand exceeds available supply. This early price increase is known as the IPO pop. And SpaceX delivered one of the biggest IPO pops in recent memory. Naturally, many investors wanted to take profits. But platforms such as Fidelity, Robinhood, ETRADE, and SoFi have policies designed to prevent what's known as flipping. Flipping simply means selling IPO shares shortly after purchasing them. According to industry guidelines, selling shares within the first 30 days after an IPO can be considered flipping. While it isn't illegal, brokerage firms can impose their own penalties. And those penalties can be severe. At some brokerages, investors who sell too early may be temporarily banned from participating in future IPOs. Others may face long-term restrictions or even permanent exclusion from IPO allocation programs. Think about that for a moment. You own the shares. The shares are in your account. The stock price goes up. But selling those shares could cost you access to future opportunities. That's where the controversy begins. Now let's compare this to how institutional investors operate. Large hedge funds and asset managers often receive massive IPO allocations. Many of them face few, if any, restrictions on selling. In fact, some institutional investors openly admit that they plan to sell shortly after trading begins if the price rises enough. Why? Because that's how they maximize returns. And unlike retail investors, they often have the freedom to act immediately. This creates what many critics call a two-tier market. One set of rules for Wall Street. Another set of rules for Main Street. Supporters of the current system argue that anti-flipping rules serve an important purpose. If everyone rushes to sell immediately after an IPO, the stock could become highly volatile. Prices could collapse. Investor confidence could disappear. Brokerages and investment banks want stable shareholders who are willing to hold for the long term. From their perspective, limiting early selling helps create a healthier market. And there is some truth to that argument. However, critics point out a major inconsistency. If stability is truly the goal, then why do institutional investors often receive more flexibility than retail investors? Why can large funds frequently sell while smaller investors are encouraged to hold? The answer may come down to relationships. Investment banks earn billions of dollars by working with large institutions. Those institutions generate trading volume, investment business, advisory fees, and long-term partnerships. As a result, they often receive preferential treatment. Whether that's fair or not remains a matter of debate. But the difference in treatment is difficult to ignore. Another important factor investors should watch is index inclusion. This is where the story becomes even more interesting. When a newly public company becomes large enough, major stock indexes may decide to add it. Indexes such as the Nasdaq 100 or broad market benchmarks often include successful IPOs shortly after they begin trading. And when that happens, something powerful occurs. Index funds and ETFs are forced to buy shares. Not because they want to. Not because they think the stock is cheap. But because their investment strategy requires them to follow the index. That creates automatic demand. Billions of dollars can flow into a stock simply because it has been added to an index. Some analysts believe this is one reason institutional investors are willing to hold through the first few weeks. They expect additional buying pressure from passive funds. And if they're right, the stock could continue benefiting from that demand. But there are risks as well. The excitement surrounding SpaceX is enormous. Yet history has shown that even the most successful IPOs can experience sharp volatility after their initial surge. Investors must remember that a great company and a great stock price are not always the same thing. Sometimes expectations become so high that future growth struggles to justify the valuation. This is why risk management remains critical. Whether you're bullish or bearish on SpaceX, emotional decisions rarely lead to successful investing. So where does this leave retail investors? They're stuck with a difficult choice. Sell early and potentially lose access to future IPOs. Or hold the stock and accept the risk that today's gains could disappear tomorrow. It's a decision that many institutional investors never have to make. And that's exactly why the SpaceX IPO has reignited a broader conversation about fairness in financial markets. Should all investors play by the same rules? Should retail investors face penalties for actions that large funds can often take without consequence? Or are these restrictions necessary to protect market stability? As investors look ahead to future mega-IPOs, including potential public offerings from companies like OpenAI and Anthropic, these questions are only becoming more important. Because the SpaceX IPO isn't just about rockets. It isn't just about Elon Musk. And it isn't just about one stock. It's about understanding how modern financial markets actually work. Who gets the advantages? Who bears the risks? And whether the playing field is truly level. What do you think? Are anti-flipping rules protecting investors, or protecting Wall Street? Let us know in the comments below. And if you enjoyed this analysis, don't forget to like, subscribe, and turn on notifications for more deep dives into the world's biggest business and investment stories.